Welcome to the Refinitiv Sustainability Perspectives podcast. Today we're going to discuss the emergence of green infrastructures and green cities, the key implications for investors, as well as the latest developments in this space. Our guest is Alzbeta Klein, Director and Global Head of Climate Business at International Finance Corporation, which is a part of the World Bank Group. Make sure to send me an email or tweet to let us know your thoughts on this topic and suggest the theme for the next episode, or even tell us your own story to get a chance to be featured. You can find my email and Twitter handle in the episode description. So here's where we are. We're seeing significant growth in investments fueling sustainable construction in green cities. Here are a few examples. There is Google, who's spending $900 million to build a new high-tech neighborhood in Toronto full of buildings made out of wood. Made out of wood. Wouldn't Abraham Lincoln love that? Sarajevo is receiving 35 million euros loans for greener public transport. And Britain is kicking off efforts for a fully electric bus town with the hope to have all electric buses by 2025. Innovative thinking around how to structure or restructure a city seems to be a key driver. Just last week, Sidewalk Labs and Michael Green Architecture announced a plan to design the world's first all-timber high-rise neighborhood. And Hawaii's recent Bill 25 proposal focused on providing more energy-efficient insulation and lighting for the purpose of reducing their carbon footprint. Now, some critics say that these building requirements may make housing and even retail space out of reach because of the costs involved. Alzbeta, are costs of energy-efficient buildings going to be a stumbling block for society moving forward?
Kisa, this is a great question. Costs are such a myth in green buildings, and I can say that they are not going to be an impediment. When we start talking to investors about investing in green buildings in emerging markets, the first question is, how much more is it going to cost me? And our research and practice had shown that the cost differential is less than 5% for most of the green buildings. And the cost of bringing these energy efficient measures are not going to be a stumbling block. And even more importantly, they'll recoup it during the operations of the building. So no, it's not going to be the case.
Well, let's talk a bit about data. Do you think that there are data gaps in how energy efficiency is being tracked now and what we're understanding about it?
Energy efficiency is like a child that nobody cares about when it comes to data, when it comes to looking at opportunities. It's one of the cheapest way to make our construction better and greener. And it's one of these things that people don't think about. They think about building new, they think about building new buildings. They don't think about saving energy through energy efficiency. And no, there isn't enough data. And we need to have more data, especially in emerging markets, because this is where growth will happen. And this is where data is going to be essential to show that you can build green, either from scratch or on the retrofits. And these data are extremely relevant to builders and to investors.
Okay, so with that being said, great segue, we have the myth of the cost involved here. We also have the knowledge that data is good, but it can be better, and we need better data for this. How can investors approach this sort of project? Say, starting from the beginning, how should you approach the Green Cities, Green Buildings project?
So first and foremost, we need to ask the question of why. Why do we actually care about it and why it actually matters? And then we sort of can go to why. So there are three reasons why we should care. First of all, cities consume 2/3 of the world's energy. So when you talked about energy efficiency, well, 2/3 is consumed in cities, and we need to start thinking about it and make it more efficient, right?
When you say cities, you mean actual cities, not outlying. Wow. Okay.
Cities globally, yeah. So 70% of global carbon emissions come from cities. Secondly, with 90% of urban areas located near the coastlines, we need to start thinking about what this means for cities, what weather patterns and changes in weather patterns mean for cities, and how you need to build to create cities that are sustainable and adapted to the future. And last but not least, and this is the most important one, 60% of cities in emerging markets are yet to be built. They're not built today. They're going to be built by 2030. So when you have an opportunity to change how we do things, this is your opportunity because, as I said, cities emit, cities are exposed to changing weather, and cities are expanding.
I love what you said about just the expansion of cities and how, goodness, that's a very interesting description of energy, just, something that no one's really dealing with right now. I think a great example is Heliogen, which is a clean energy startup. They recently made a pretty promising step toward addressing embodied carbon in cement, steel, and other building materials. They announced that it can harness solar power to generate industrial heat above 1,000 degrees Celsius using artificial intelligence and, get this, a field of mirrors, which I thought was quite interesting. So, Alzbeta, now that we understand the costs, or the cost myth, we understand the importance of data, but with this artificial intelligence and using these types of things, talk to us about emerging technologies and how they will impact green cities and green buildings.
Absolutely. So first of all, your example was very timely because what this company is doing is reaching hard to decarbonize sectors. So those are sectors where there's a fair bit of innovation, but I would say not enough. And what this company is trying to do is decarbonize cement, decarbonize steel, or at least lower the carbon footprint. This is the cement embedded in buildings. So there are two buckets of innovation. One is the innovation in technologies, and one is the innovation in finance. And we can maybe start with the technology innovation. So we have a tool called Edge, and that's a tool that is specifically designed for emerging markets, green construction. Anyone can access it online, and anyone can put in basic characteristics of their building and start playing with various parameters. So as an example, you are in Mongolia. Mongolia is a country with huge differences between the temperature in the summer and in the winter. In the summer, you've got temperature in the 90s, and in the winter, you've got temperature in minus 30s Fahrenheit. How do you build a hotel in Mongolia? Well, you can play through our software whether you are going to put a single glaze window, a double glaze window, or perhaps triple glaze window, and what that means in your cost structure and what that means in your carbon footprint of the building. And through those technologies, you can clearly see how you can build a building that is much more energy efficient. Our architects are telling us that you can build a building that has a lot more natural ventilation so that you need less air conditioning in various markets. So there are technologies that are allowing you to do it. And I guess later on we can talk about innovation in finance.
Great. So, with that being said, just getting back to investors for 1 second, who is the ideal investor for green cities if we're looking at that as a market?
Investors, actually all the investors should be interested in green cities, and I'll tell you why. Because it's one of the biggest investment opportunities that we have in front of us in the next 10, 15 years. We have done a study about cumulative investment opportunities in cities, and that investment opportunity by 2030 is somewhere in the neighborhood of $29 trillion. When you talk about $29 trillion, this is what has to be built. This is what is going to be built. This is not about which investor. This is about how we bring the most investors into this sector and how we help them de-risk their investments so that they are comfortable coming into the emerging markets. And that has to do with things like making sure that a city is credit-worthy, making sure that a city can borrow, because we know that public budgets are not going to cut it. But when you look at these kind of numbers, it's not which investor can come in. We need all of them coming in, but we need to de-risk it so that they are comfortable coming into the sector in emerging markets.
So what should be their path? How should they enter in?
So there's a couple of things. First of all, we've got a number of cities in emerging markets that are already starting on a path of having an investment credit rating. And obviously those cities are more credit-worthy and investors are more willing to come in. But we have a number of initiatives at our sister organization, the World Bank, which works on creditworthiness of cities. So helping cities to become creditworthy so that investors can come in and start investing. And then the next step is to look at the sectors where investors are coming in. So when you look at things like bus rapid transit, this is something which you're familiar with. I think you mentioned it in your introduction. It's something that investors know how to do in a municipal finance space in the United States, in Canada, in Western Europe. They know how it looks. It's going to look pretty similar in emerging markets. When you look at things like waste management, waste treatment, those are new areas, not only in emerging markets, but even in developed markets. And this is where you need to think about de-risking and perhaps blended finance, where financiers that need perhaps slightly less return come in and alleviate some of the risk so that commercial investors can come in and gain commercial returns. So it depends on the sector, it depends on the area, it depends on where the city is in its own creditworthiness. But the goal is to create solutions that crowd in the maximum private finance into emerging market cities.
Great. So we talk about sectors, we talk about de-risking. How can investors use ESG data to help them make these decisions?
So ESG data it's a great question, because ESG data until maybe 4 or 5 years ago was something that was collected on the sidelines. It was something that investors that had a particular interest in it were looking at it, but it definitely wasn't mainstream. In today's world, you can't read mainstream financial press any day without finding an article about ESG investing, about climate risk, about climate resilience, and it really became a mainstream. So we see financial press writing about it, and then we see investors starting to talk about it. So announcements from BlackRock recently, announcement from Goldman Sachs, announcement from several other investors that total something like $40 trillion of assets under management, talking about the need to look at ESG criteria when they invest and then invest accordingly, is definitely bringing that topic to the forefront. But data is not perfect. There are several sources of data that we all use to assess that risk, but it became from nice to have to essential to have. And when you have something that is essential to have for your investment decision process, that means that there will be innovation in data, there'll be companies that are going to be crowding into that space, and there'll be providers of this data that will tailor it to the needs of investors in that space.
Okay. So it sounds like getting the best type of data is really the best decision that an investor could make here. And I know that Refinitiv, with our ESG data objective, a very rich history of data there. So that is definitely how an investor, one way an investor would want to approach moving forward. How can we effectively measure the impact of the bottom line if we look at these type of investments?
That's a great question, because a lot of companies are thinking about it. I was just yesterday at the board of Center for Sustainable Business at the New York University, where I'm a member. And there's a new methodology called ROSI, Return on Sustainable Investment. And there are a number of academicians and practitioners who are thinking about that. But even more importantly, it's about what is happening on the ground. And you can see it in how the cities are being built and what kind of financing they can attract. We have done work with the city of Ahmedabad in India, where we looked at they asked us to look at their lower carbon trajectory for the city development. So we helped them design that. And as a result, they selected few pilot projects, and they are on track to issue their first green bond. So it's not just what you are seeing in paperwork or in research. It's what kind of funding, what kind of finance the city can attract at the end of the day. And that's the proof that it actually worked, because you've got investors who are interested to come in and invest in those projects. The other thing I want to mention is that a number of cities in emerging markets are hiring chief resilience officers.
Chief resilience officers.
Chief resilience officers. So those are the folks who are looking at the city and the city's ability to adapt to changes in weather and adapt to changing circumstances of the city. And in our report, we have insights from 6 chief resilience officers from Da Nang in Vietnam, from Mexico City, from Semarang in Indonesia, Porto Alegre in Brazil, and others, who are looking at what specific requirements the city needs to be able to withstand impact of weather, population density, geography, and other considerations. And that in itself makes investments more sustainable, and that brings you more investors to invest in your city, and then allows the city to issue a green bond or have a green loan and crowd in the investments that you need to have to get the city to be sustainable and on a sustainable growth pathway.
It really seems like all of this information really leads us back to the need to have really good data. Even with this new role, the Chief Resilience Officer, they're measuring and looking at how a city can be impacted, withstand weather, population, et cetera. They're getting that from data.
They need to get that from data, and we need to get better data now. The good thing is that the data are becoming more available. We've got, we as IFC invested in a company called Planet Labs, which are low orbit satellites that bring in data with a pretty good accuracy. But it's not just the data, it's processing it into an information that investors can use. And I think you had on your podcast colleagues who talk about TCFD, the disclosure for financial institutions about climate risks, and SASB, which is also promoting disclosure, and others who are bringing disclosure. Disclosure gives you more data. Data allows investors to assess risks, and that allows them in turn to invest. So it's a bit of a virtuous cycle that you have when you have good data, when you have good information that is processed into usable data by investors, and that crowds in investments into cities. And going back to where the investment opportunity is and how large the investment opportunity is, I think it's something that we all need to think about how to crowd in investors, pension funds, mutual funds, others into opportunities that we see in cities and emerging markets.
So with that being said, it sounds like that there are some gaps that we really need to manage better in terms of the information, the data that we receive. If you had a list, Alzbeta, of the top 3 ways that data can influence the future of green buildings, of green cities, or just, how we can manage some of the gaps that exist, what would those top 3 things be?
So I think, first of all, I think we need to go back to creditworthiness. So data on the ability of the city to borrow and to repay, and that's sort of financial data. So that's something that is not uncommon in developed markets, but it's still lacking in emerging markets. So just the financial data on what cities need to be creditworthy and to be able to go to capital markets and to be able to borrow. The second one, I would say, is data on what the city needs, because that data allows you to create bankable projects. What are bankable projects? Those are projects that you can invest in as an investor. And we need to have good data to be able to structure those. And then last but not least, it will be data to narrow financing gap in the city. So again, it's a combination of data from the city on geography, on the needs, on population growth, on projected revenue growth, potential tax base, but also environmental and social data that you need. And that allows you to then structure financial instruments that would allow you to narrow the creditworthiness, narrow the gap so that you can crowd in finance. Example would be, for example, data for base of issuance of green municipal bonds, right? For every green bond that a city would issue, they need to have a data structure embedded in their city government, in the municipal government, to be able to support that green bond with the green projects. It's data on land value capture, which is when you build a lot of public infrastructure, your land appreciates and value of that land should be factored in. So again, data on everything that a city needs to narrow the financing gap would go a long way.
Great. Alzbeta, finally, what is your big idea? What do you think is going to be happening in the green building space that's really going to take the market by surprise, say over the next year, over the next couple of years? What can we not expect but need to start expecting at this point?
So I think the biggest issue will be that you are going to see mainstream investors thinking about how to bring green buildings into emerging markets. That is going to be the likes of large hotel chains who are going to be building and contracting to build very differently because they know they can do it right the first time and they don't have to do the retrofits. And you are going to see investors that you never thought about being in that space to be in that space, because with the announcements that we heard from BlackRock and all the others, it forces investors, it forces asset owners, and it forces companies to think very differently. So the big idea is that we will go from nice to have to essential to have. And for that, you need data, you need finance, and you need de-risking tools to make it happen.
So from cost being a myth to the critical need to have good data, to really understanding the way that these entities need to partner together. It sounds like the future is very bright for green cities and green buildings.
The future is very bright, very green, I would say.
Very green.
No, the opportunity is very green, and I hope the future will be very green as well.
Great. Alzbeta, thanks for joining us.
Thank you.
Now a note to our listeners. Are there important insights about green infrastructure that we missed? Or would you like to suggest a theme for the next episode? Please email me or reach out on Twitter @Refinitiv using #RSPodcast. See the email and Twitter handle in the episode description.